Welcome to the Halftime Report, DeYoe Wealth Management's 2018. So where we've been, here we got USA. Why do we have USA wearing with the thumbs up? Why do you think? In the last 6 months, US markets is on top. This is the last 6 months. The last time we met in this room was right there. So in January, right about here, we wrote the letter that clients got, and we said, this little nice steady slope is over. That is completely an anomaly. We should never expect that kind of experience. And then the very next day, the world fell apart. See, that's why you do business with us, I think. I know, maybe. You're saying I caused it. Oof. But I want to show you this a different way. This is weekly returns for 2017, and you can see January was fantastic. In January, we saw a 5.5% print. And then immediately in February, we lost it all in the first 2 weeks. We gained some of it back, lost it again, lost it some more, and it gained back, and went up and down and up and down and up and down. This is volatility. The thing that's strange about this is this. So let's look at the longer context. This is from 1996 to 2018. Look at this. This is 2017 volatility. This is the number of days when stocks moved up or down by 1% or more. Only 4 days in 2017. So that sets our expectation that volatility, or that lack of volatility, is normal. So going into 2018, that's why we did the warning. Not because I thought the market was going to fall apart the way it did. That's not me being prognosticating or guesswork. That's me saying, hey, this thing that we just enjoyed, not reality. The reality is we're going to experience, on average, 34, 35, 1% moves every single year. Expect it going in. Make sense? What's happening now? The important part here, US tax cuts, fiscal stimulus. So we saw the market volatility surged because of this other part. Policy risks, sustained commitment to monetary tightening from the Federal Reserve, and this aggressive trade posturing. These are all the different sectors. This is January 1 here at the beginning. Notice how we got a couple at 10, a couple minus 10, a couple at 4, 5, 1 at 5. So we have the S&P up 1.67 at the end of the first 6 months. That's all these different companies doing different things and ending up as a market, up 1.6. So big chunks of the economy up 10, big chunks down 10. Averages out to about 1.6. This is just to say that no matter what the market's doing, there's always an opportunity. There's always a place to find performance. This is what we have for the year. For the first 6 months of the year. This is the US. We said this earlier. The US is up. Everywhere else is down. This is REITs, Dow Jones Industrial REIT Index, domestic. So do you remember what this looked like when we met in January? We were looking at 2017. We're looking at the year 2017 in January. Do you remember what it looked like? Does anyone have? Okay. So the US for 2017 was up substantially, 22-ish%. But remember, emerging markets and international were up even more. So the international market outperformed. And what do you remember what I said about it? This is why we have to do these every 6 months. Okay. So what we said about it at the time was it's long overdue that international markets catch up and begin to outperform the US. And it happened for a little bit, for a year, and then it reverted again. So this USA first, the return to USA first, based on some of the things we saw in that quote, don't think this isn't intentional. Right? We're moving from a globalized world where everything is integrated and everything is together and everything is, the global economies are interrelated and interdependent. And we're moving away from that towards a US-centered focus in the US. That's why we see the return to this. Because that earnings improvement happened in the US for specific policy reasons. What's the one reason? Tax cuts. Okay. Lots going on in the world. Very few companies did really well, or very few countries did really well through June 29th, through the end of June. I think what it's related to is strong dollar. Very strong dollar is the biggest thing. And that's what we're seeing. You remember, what was the Kudlow report? Is that what the Larry Kudlow, who's now, the Kudlow report, at the end of every report, he talked about strong dollar, strong dollar, strong dollar, strong dollar. I think that's the camp that we're coming from. And so that strong dollar hurts resource countries, and a lot of emerging markets are very resource dependent. Tax reform was the fairy godmother of corporate earnings. So corporate earnings, and we've talked about this here a lot, the thing that drives markets is earnings. Earnings drive markets, earnings drive markets, earnings drive markets. So earnings, there were 2 quarters in the last 30 quarters where earnings, expected earnings were increasing mid-quarter. When were those 2 quarters? First quarter of this year, second quarter of this year. That means even though we knew that legislation was signed, even though we knew that the tax rates would be a benefit to corporate America, we didn't know how good it would be. We underestimated how good that benefit would be for corporate America. And it is an incredible boon. So first quarter, second quarter's not in yet. First quarter, 25% increase in earnings on a massive economy. 25% increase in earnings. So this is the earnings across this is March 31st. So in the quarter, you see the earnings estimates are increased across the board. Every single sector. So it's positive across the board. The green is the beat rate. So everyone knows that corporations manage earnings expectations. And so there's usually a beat rate that's above 50%. The S&P beat rate right now is 78%. 78% of the companies that report earnings report better than expected earnings. 78%. 17% have reported below expected earnings. It's the percentage of the companies that are reporting earnings that are greater than expectations. They beat their earnings estimates, the beat rate. So when you have a surprise, the long-term average of a surprise in earnings has an effect in terms of stock price. And what we're seeing right now, the negative surprises are yielding a negative, so this is the long-term average, 2.4, currently 2.3. So when something reports a negative, it's being reflected in the stock price the way you'd expect. When someone reports a positive, it's not being reflected in the stock price the way you'd expect. Do you have any idea why? The downside would be met with, oh yeah, that makes sense. We have a negative earnings surprise, the stock market goes down. But if a positive earnings surprise, it doesn't go up the way it has in the past. So this 1.1 is the historical, how the prices move, 5-year average, how the price of a stock moves when there's a surprise earnings on the upside. This is how it's moving right now. We're not seeing a market adjustment to say, oh, good job, surprise on the upside. So what he said was, maybe it's because the tax benefits are going to be realized this year, and then the real benefits aren't going to be there anymore. So let's frame it a different way. From an investor's perspective, I want a company's earnings to increase, but I want them to continue to increase. I want them to increase not on a one-off thing. I want them to increase by more sales of widgets and services. Right? I want them to actually do more business. This is not them doing more business. This is them receiving a one-time, here's a benefit, which is wonderful, but this is what the forward-looking PE ratio, it was 18.5, it's now down to 16. Look at the average, 5-year average, and then 14.25 is a longer-term 10-year average. So we dropped because the market didn't move, and because earnings did move, we dropped to a pretty reasonable forward-looking PE ratio, where we used to be sort of overvalued. We're less overvalued now. But wait. Do you remember looking at the CAPE ratio? Remember talking about the CAPE ratio? So the CAPE ratio is Shiller's average earnings over a 10-year period ratio, okay? So what happens, those of you who are here, you might remember that there's 3 things that we sort of anticipated would happen. 2 big ones. Let's talk about those 2. One, we said earnings are going to go up, right? Tax rates, there's no question earnings are going to go up. They're going to go up a lot. That's what's happened. So that's thing number 1. But what else happens next year? So it's 10 years. This is a horrific, wow, that's really overvalued. But remember what the 10 years are. 2008, 9 through 17. So what happened in 2008, 2009?
Recession.
So not just recession, earnings went to zero. But why did earnings go to zero? What was happening? Not just recession, not just financial calamity. They were writing down their previous 4 years of earnings. So we got all the bad stuff in 8 and 9 in this calculation, none of the good stuff in 6, 7, and 5, 6, and 7. Right? So all the bad negative things that happened that we overpriced and we claimed earnings that didn't exist in 5, 6, and 7 came off the books in 08. That's still in this ratio. So that's holding it up a lot higher than it actually is. So when you hear CAPE ratio, you have to recognize that it's not as bad as the pundits are saying, because they don't peel the onion. They just go, oh, it's a horrible number. But there's a lot in that they're not looking at. So I think this is actually a pretty good indication of what the value is forward looking. I think this is a pretty good indication. So there's other bits in that. So when people are defending, when they're not believing the CAPE ratio, they also point to these things. The economy is more global than ever, interest rates are low, corporate earnings are strong, and this tax cut is not filtered through the system all the way. All reasons to think that valuations might be reasonably higher. Reasonably higher. This is something we've talked about for years and years and years, probably 5 years, anticipating raising rates. You know, it's going to happen, and all the time it went down, 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 down. And we started 2017. We saw the first pop, and it was kind of steady. But we pretty much know the trajectory of interest rates now. How far they go up, how long, how far in terms of the percentage, and how long it takes to do that, anybody's guess. We might see a retrench here. We might see the Fed slow down. We have no idea. But we know that rates are low and increasing. This is potentially a scary slide. I'll give you a second to digest it. So this is what happened. 1.9 trillion in tax cuts, a bigger spending bill than we anticipated, leading to a $1 trillion annual deficit by 2020, and 16.5 million. This is trillion. Thank you, trillion. This is owned by the public. This isn't government agencies owing each other. This is public-owned debt. Okay, so hold that 16.5 trillion in your head for just a second. We're going to get to that in a sec. So this is who owns it. So since 2007, foreign ownership has skyrocketed. But see how it's tapering out? And see how this one's tapering out? See how this one's kind of tapering? So there's some increase, but that increase is tapering. The delta is reducing. What do you think that affects? What does that make happen to the rate that we have to pay? The rate that we have to pay on that interest is going to go up. Okay, now this is where it gets freaky. 16.5 trillion, 2020. So at 5% interest, 16.5 trillion is $825 billion in interest payments alone. That is more than the defense budget. That is equal to our Social Security. Okay, so what is the thing that's not true there, though? Yeah, it's not 5%. What do you think the average is? What's the average interest rate on the Treasury debt? It's about 2.5-ish. So it's actually 412 billion. So here's the risk, right? So what's going to happen is we're going to have crowding out, and we already expect that. We already expect some of the services won't be able to be afforded. So they're going to have to come up with either a reduced service load, which means social services, or they'll have to come up with increased taxes, or we're going to keep building the debt, which sort of magnifies this problem. So is this sustainable? No. Okay. So if something's not sustainable, what happens? It's not sustained. We don't know how it's going to work out, but I'm going to anticipate there's going to be some reduced benefits in some places, increased costs in others. So there's already, and there has been for 15, 20 years, methods of reducing the costs of Social Security, means testing. Personally, I think that makes sense. If you have $500,000 in income, why do you need a Social Security income? It requires a change in the law. That's going to be hard to make right now. Right? So there's lots of ways to resolve it. It's an issue that we're going to face. This is one of the things that could drag 4 years from now. It's not going to affect anything now, but it's one of those things that can come up. So we talked a little bit about this. Emerging markets are down. We're going to say, does that mean we should get out? Absolutely not. I mean, we are committed to international and emerging markets investing. And the big reason is equity market capitalization could double, in the next decade. Why? How many people do we have here? 350 million? How many people are entering the middle class next year in China? 250 million? Next year after that, another 250 million. Next year after that, another 200. There's so many people, and they will have enormous demands. China is doing its level best to make sure that the Chinese companies fulfill those demands, and their neighboring trade partners fulfill those demands. They're not, this is the big argument. We don't have open access to the Chinese markets. This is part of the argument. So if we don't have access to the Chinese markets, and we don't have pure access to all the markets, then we have to invest internationally to take advantage of these opportunities. Does that make sense? Do you think that makes sense, and that the sense that makes overrides the concerns about, well, emerging markets are down 7.5%? I do. I think the opportunity is huge. I think the valuations suggest it's a better place to put money. So this is just a stack of of European growth. Last year before that, Europe grew faster than the United States. We've been trying to step on the gas. We finally stepped on the gas, and now Europe is tipping a little bit. Does that mean we're out of Europe? No, it's just something to be aware of.